All right, let's talk about US debt and mortgage rates. So that is the biggest fly in the ointment right now. Why my rates can't come around. So as the US has more and more and more debt coming to the market, they're having to issue more and more securities to the market with a drop in the bond, which is an increase in the yield. In layman's terms, that's an increase in interest. So as there's more and more debt, you have to pay more interest essentially to attract money. So that's exactly what's going on. So as the debt levels rise and it's picking up pace, there's going to be more and more debt going to the market. The 10-year treasury, which is a long-term treasury with the federal government, is pretty much what mortgages usually will kind of follow with the spread. So mortgages always have to pay a little bit more because mortgage companies have to make money, and there's also a little bit perceived extra risk perceived. So number two reason why the rates are going up is perceived risk of default. So US used to be the gold standard of debt, used to be the very best you could get for debt. Well, with the amount we're issuing, we've been downgraded already by one agency, and I understand we're getting a downgrade with another one. So our default risk is going up. As the default risk goes up, yields must go up. Interest rates must go up to compensate for the perceived risk. Inflation expectations. So we've been funding massive amounts of money into the economy that causes a bunch of inflation. As you're pumping a bunch of money in, it's going to be inflationary. So we're still struggling trying to get the inflation to totally come around. It's being really sticky. Fed reserve policy, this has massively impacted us. In the past, the Fed would buy mortgage-backed securities to drive the ridiculously low rates we saw in the past, the 2s, the 3s, and the 4s. They've talked about in the meetings that they're no longer going to buy mortgage-backed securities. So they need to have their books available to buy U.S. debt. So we are no longer going to have that, that crutch there of driving rates down if the economy slows down from what they're saying. So very interesting move there. Investor demand for bonds. So as in times of economic uncertainty, typically people will buy U.S. debt and mortgages too as a safe haven. However, if the confidence in the government fiscal health wanes, treasuries might fall, yields might have to go up, pushing yields and rates even higher. So even if we get into dicey times, it doesn't mean the rates are going to come down. So the projected interest rates with Mortgage Bankers Association, 5.9 by the end of next year, and not to do any lower the next couple of years after that. So basically, people are holding out for the 2s, 3s, 4s, and even the lower 5s probably is never going to happen. So any questions, let me know, and hopefully we'll get a bipartisan solution to the debt. That would be a very good thing.